Okay, good morning, everyone, and welcome to what is now the 69th edition of the Coffee Microcaps Morning Meeting. You're all very welcome. For anybody who's joining us for the first time, my name is Mark Tobin. I am the founder of Coffee Microcaps. I've just got a quick few intro slides I'm going to run through, and then we're going to get straight into it with our first presenter. Firstly, I'd like to thank the team at DMX Asset Management for the sponsorship of our virtual events, which helps keep it free for you, the attendees this morning. Compliance and disclaimer slide. For anybody who is joining us for the first time this morning, the companies we generally have presenting on here are capped under 300 million in revenue and approaching cash flow break even, or indeed in some of the cases this morning already profitable. We don't tend to have companies from the resources and the biotech sectors. So a catch-all term I like to say is industry microcaps, which covers kind of all the other sectors, whether that be healthcare, financial services, industrial products, engineering businesses, basically anything that's non-resource, non-biotech. Structured this morning's webinar, if you're joining us for the first time, we've roughly got 30 minutes for each presenter, which will break down into a 20-minute preso and 10 minutes of Q&A. If you do have questions for our presenters, please type them in the Q&A box rather than the chat function. It just makes it easier for me to moderate the questions. And please note the webinar is being recorded and it will be posted on the Coffee Microcaps YouTube channel tomorrow morning. You can follow us Twitter, YouTube, LinkedIn, as I say, YouTube for this recording and indeed all of our previous ones. Up first, we've got Scott Farthing coming back to give us an update on all things EVZ Limited. Then after Scott, we're going to have John Thompson coming back to give us an update on all things Knosys. And then finally, we're going to have Ron Hodge, also a returning presenter, to give us an update on everything InvestSMART Group. So that's enough from me. I'm going to stop sharing our screen. And Scott, if you want to start sharing your screen, I'll let you know when I can see the cover slide of your presentation. Yeah, there we go. I can see it now, Scott. You're good to go, mate.
Good morning, everyone. As Mark said, my name's Scott Farthing. I'm here to present you to EVZ Limited. If you haven't heard anything about EVZ Limited, I'll give a quick introduction. If you have, bear with me, and then we'll move on to some more current information. So EVZ, well, we work across Australia, Southeast Asia, and in part in New Zealand. There are 3 businesses in the group. It was established in 2004, and we currently have a direct workforce of 320 professional engineers, technician and tradespersons. Our major shareholders there are on the screen: Thorney Investment Group Australia, Salter Brothers, and the board and management have some other up-and-coming growing positions in our organisation also. So there you can see the locations of our permanent offices. We do trade in New Zealand quite readily. We also trade in other parts of Southeast Asia, and we are hoping, as the pandemic widens, to establish some more positions, permanent positions in Southeast Asia as the market returns to normal. Okay, so it's 3 businesses. Brockman, which is a provider of, well, its specialist area is steel bulk storage tanks in the water, gas, and oil or liquid fuels industry, and applicable to mine sites, to chemical plants, and other major industrial facilities, in addition to fuel refineries, fuel terminals for marine and land transport use. We also do a lot of associated works to augment the steel bulk storage tanks, pipe networks, vessel repairs, general fabrication and maintenance of major gas and liquid fuels facilities. Our client base is mostly the big oil companies, with serving also a few minor and up-and-coming oil companies. So we deal with people like Viva Energy, ExxonMobil, Ampol, or Caltex as they were previously known. We also deal principally with a lot of water authorities right across Australia. We deal with some of the big gas providers and mining companies in the West, and we tend to try and stick with the blue chip, sizable balance sheet organisations in that industry. Brockman provides about just over 50%, 54% of revenue to the group. And it is the one at the moment, and I'll cover a bit later, is the element of our business at the moment that is going under the most significant growth. Siphon is a building products business. It provides siphonic drainage systems to major buildings. You can see there a little photo of a tennis centre, but buildings of that style, low, flat buildings. So at the moment, you can see there's significant amounts of investment going into warehousing and last mile distribution centres and large regional distribution centres. So shopping centres are also a big favourite of ours. Significant manufacturing facilities are a favourite of ours. Sporting precincts, just like that one there. Stadium Australia in New South Wales recently is being completed by us. Melbourne Park, etc. So anything that's large, technical, has large amounts of water on the roof. We have a very efficient stormwater roof drainage system that is probably the leader in Australia and Southeast Asia. We have market share of more than 75% in both markets. I think in Australia for a moment it's probably about 85%, and in Asia it's probably about 75 to 80% of market share. And that's come through providing a premium product by acquiring a few of our competitors over the years and delivering the super high quality service and premium backup to our systems. And the third business, a small emerging business, only about $8 to $9 million revenue at the moment, but growing at about 30% per annum, is TSF Power. And TSF Power is involved in the gas renewable energy industry. So it's using waste gas, methane or biomethane or biogas, whichever it is, that may be formed or created from a sewage treatment works, landfill gas industry, landfill gas, or dairy or coal mine or the like, capturing that gas and converting it into electrical energy. So reducing the ozone depleting potential by reducing the methane content or biogas content and converting it into electricity. Our business is a installer. It is also a principal area of business is in technical support, operations and maintenance for that industry. And you can see there, that's a typical 5-engine facility in that little photograph there that we would maintain. You know, companies like EDL use us for their servicing their engines, for looking after their plant, providing them technical support so they can get the best efficiency out of their engines, the best life of their componentry, and they can make they can improve their revenue stream through using our services and our technical support. TSF Power is also serves the diesel backup emergency power for many different clients, whether they be data centers for a power for all of the things we're using right now to connect to each other, major healthcare facilities and other large facilities such as CBD buildings, casinos and the like, where emergency power is really important. Okay, so I'll just give you a bit more background on the businesses so you give it a little bit of a hand. So this is a typical project, that this photograph on the screen is a typical project of Brockman Engineering, whether it be a 2-tank install, a 4-tank install, or even just a repair of a tank or a new roof or a change of use of one of those storage tanks. This is actually the United Petroleum facility at Hastings, where we recently completed the 2 tanks on the far right of the screen. So this is a typical $30 to so million project for us, being 2 tanks. And we would take around about 18 months, 12 to 18 months from order to finish. So about 4 to 5 months for procurement and preparing the works, and then about 12 months to build, 8 to 12 months to build one of those tanks and commission it. So, or 2 of those tanks and commission them. So that's a typical project you'd see that would be an underpinning revenue stream for our business. And we've got a few of those on the books at the moment. Recently, watching the announcements, you would have seen we secured the Viva project, the diesel project for Viva. There are 9 more of those to come to in play in the market at the moment. And the Viva project would be equivalent to 3 of those tanks on the right there. So it's a sizable project, about $40 million or a little bit more. And there are 10 of those. I'll talk about those in a minute in the market at the moment. So this is what I'd call a typical 2022, 2023 siphon project. There's a boom in the world of people changing their supply chains. There's a boom in the world of people changing the way that they integrate with commerce, how they buy, how they acquire goods. And this facility in Western Sydney, the Amazon facility, is one of ours. And this type of facility leads to the use of siphonic roof drainage. And it does because siphonic roof drainage has some technical advantages in buildings of this type, which can reduce significant costs, but also provide a much more efficient roof drainage system that provides the owner, Amazon in this case, with a much more assured roof drainage system. So, the La Nina in the eastern coast of New South Wales, eastern coast of Australia, sorry, is been keeping the clouds in the sky, keeping the rain coming down, and it provides a lot of surety to clients of this type. People just as simple as Bunnings, large facilities that don't want water in their ingress into their facility to ruin their stock. They use siphon exclusively. So this facility is coming to an end as the facility is just being completed. You can see there's a bit of sort of mobilisation and cleaning up there at the moment. This is a relatively recent photo. Excuse me. And we would be working at the moment and getting new inquiries on projects like this every month. We'd have 2 or 3 of those on the go at any one time. This, as I mentioned earlier, is a typical location for our TSF power crew to go in, do some technical checks, bring some more efficient parts. If you've ever or had a friend or watched the people revving up and hotting up engines in cars, well, this is a similar way. These are gas reciprocating engines. They are engines that can be, let's say, souped up, hotted up with better components from around the world, principally Europe, that we have supply chain agreements with. We can improve the efficiency of the engine. We can get 3 or 4% more electricity production out of the same amount of gas by improving the overall thermal efficiency of the engine. We can maintain, we can operate, we can solve difficult technical problems related to the gas quality. Typically, the gas quality in biogas is quite poor, and it destroys the engine components because of the, let's say, impurities in the biogas, because converting it to biomethane is an expensive and challenging process. And if you're wanting just to make the most amount of electricity and therefore the most amount of revenue out of any waste gas stream, you want to get the highest quality componentry, but also componentry that's got the right lifespan so you can maximize your use run hours. So this is a typical location or typical place. This one's actually a stock photo because the photos I have is not, you can see the American flag down there, is not very good quality and show as much detail as this one, but this is a typical location and the sort of job we're involved in, either by installing the new equipment or maintaining and operating in long-term contracts. Okay, so we see FY23 and 24 as a growth market. We see the rebound from COVID as being a place where our organisation will benefit substantially. The driving forces behind that in Brockman are the diesel program. The government's committed $260 million, which is 50% of the $520 million construction cost of new diesel storage tanks across Australia. We're involved in 2 of the 3 that have been let so far, and then I'll show you those in a moment. Cleaner Fuels Initiative, where the government's investing $250 million of $600 million construction cost of new ultra-low sulphur gasoline process plants at Viva Energy in Geelong and Ampol in Lytton. There's in coming years, maybe not FY23, but FY24 and beyond, there's a conversion or addition, augmentation of the Geelong Energy Hub to include, next to the refinery, include a hydrogen production plant, LNG terminal, process plant, and solar energy farm. And some of the work we're doing on the diesel program for them is starting to pave the way for some of that work in that northern end of their site. And we're also noticing, and this is quite expected, that the capital expenditure that was deferred during the pandemic due to shortage of cash flow, shortage of use of their fuels, is now being caught up on. So it'll take 2 to 3 years to catch up on that capital expenditure or sustaining capital deferred expenditure that was not achieved in 2021. So we're seeing quite a significant uptick in growth and revenue in 23 and 24 at Brockman. Siphon systems, we mentioned a moment ago that the warehouse development is significant. There's a construction boom, augmenting the supply chain, changing the supply chain. Once upon a time, it was central distribution centres, maybe one in Southeast Asia, for Australia, one or two across in other parts of the world, and one in the US, and one in Europe, one in the US, one in Africa. We're now seeing, because of the supply chain issues that we are all aware of, and the huge volumes of moving of goods and restrictions due to COVID and the like, well, those supply chains have been rethought, and we're seeing investment in more localized distribution centers and the like. And they're popping through our, let's say, our tender inquiry link almost every week. And we see an significant economic rebound in Southeast Asia and a return of the construction boom. We see that across Indonesia, the Philippines, we're seeing it in Vietnam, and as the manufacturing changes its shape to suit the world's new requirements. And TCF Power, as Australia converts to a greener energy future, capturing that gas, converting it to electricity, reducing the ozone depleting potential of the methane, the biogas and the like, is a significant area of investment that we expect to continue. Okay, so this is a quick update on the diesel program. There's not much new there. That's really what I've already spoken about. This is the update where we're at. So there are 10 projects. The green ones have been let or are about to be, or have been let or committed. The blue projects, the bids that are active right now are expected to be bid in the next 12 months. So there's been a little bit of extension of time because of the planning for capabilities and planning availability in some of those regions, some of those sites. But all of those, with the exception of Stolthaven, which is on the top right-hand side, have signed grant agreements and are underway in either a planning, tendering, engineering phase. And the first three to get off the rank is Viva Energy. That was our first win. Ampol, we've secured the early, on the right-hand side at the bottom, we've secured the early works package, and we're expecting to get the remainder of the works in the next couple of months as they go through their investment decision. And Coogee Chemicals was won by one of our competitors. So just give you a quick look at Melbourne Water. This is a typical job we do for the water industry, 10 to 15 megalitre project, augmented a water supply chain for the water supply entry point for the northern suburbs of Melbourne. We do 2 or 3 of these a year across the eastern states of New South Wales, eastern states of Australia, as the communities grow and water supply needs increase. So the big news for our business has been the stabilisation of the next 2 years after a challenging couple of years in the pandemic. So you can see there as the pandemic bit and the workload and the commitment of resources and the commitment of investment, you can see that March 21, we started to return slowly. You can see the workload starting to fall from March 20, where clients were withholding their commitment to future projects, and now you can see the backlog. So the revenue, this is a graph of revenue backlog, which is the total of amount of contracted work the group, EVZ Limited group, has committed in future work. So you can see there we were about $45 to $50 million of committed work. And the pandemic hit, that shrunk down to around the $30 million mark, and that, we were hand to mouth there for a while as the commitments to expenditure were limited. And now you can see that number is above 100 million. And we expect that to stay there as we do the work, because every month we do the work and that reduces, and every month we win new work. And the only reports I'm having from my people and from my clients is they're looking to spend more. And we expect that $100 million threshold will be maintained above that number for some time to come, which provides us a growth basis and provides us for stability of revenue and profit growth and the like for at least the next 2 years, possibly. We're hearing commitments that will come over the next 2 years, it will probably push that that number above that threshold for longer than at least 2 years. Okay, so where we are is we think leveraging our capabilities and the momentum and what's starting to build. I think scaling up our business is the intention, and certainly the plan and the strategy that we're implementing at the moment. Are likely to be much significant more revenue in FY23 than 22 and 21, probably up to 50% more revenue. Significant current activity out there is just going to continue that growth and opportunity for our business. We're able to manage our inflation risk through a commitment of trade cover and very short-term terms with our clients for pricing, and taking out the risky elements for inflation so that they're on the client's risk side. Certainly growing our skills base. We've hired 20 new persons in either trades or professional in the last 2 months, and I expect that ratio to continue over the next 2 to 3 months of 10 to 20 persons a month. So particularly in Asia, as the construction industry rebound occurs, and the new opportunities in the energy transition. The talk around Australia for the last few months and coming now with the new government is certainly about the energy transition. So we're really keen to capitalise on that opportunity. And we're also seeking collaborative merger and acquisition opportunities. Certainly, got a lot of like-minded opportunities out there for us to talk to and to try and structure up a deal that suits the intentions of our business and share with others. So this is a project, just quickly to finish off, because I know we've got time constraints. It's a project that we won last year in Penang. This is the sort of facility we'd win in Asia 2 or 3 times a year, and we'd have a lot of infill projects in between. There's a significant project for us in Penang. Penang's a very large development area at the moment, big investments in Penang going ahead. And there's just a rehash of the first half 22 financial report, which really just shows what our business looks like when it's in, let's say, low mode, because the first half of 22 was really much similar to the previous 2 halves during the pandemic. 30 million turnover is part of our low stop position, and just keeping a profit. All of our businesses are profitable. They maintain a profit through those periods, just lower profits than they will be in the next couple of years. Here's the revenue distribution. The balance sheet has been improving over the last few years, and we'll cross the threshold of no debt, no term debt on the 30th of September this year under a debt reduction program we've been running for a few years, which will be a great moment for EVZ. I think it's the first time since 2004 we'll be debt free, cash debt free, and our safety performance is at a very high performing end of the spectrum. They're very low incidents and very good figures. So it's all about our people and looking after them and growing their talents as well as keeping them safe. So I'll open up for questions.
Thanks, Scott. We got 2 questions actually emailed in ahead of time, so I'm just going to work through those first. So I'm just going to read out the first one. How is EVZ managing labor shortages, materials, and parts of the supply chain in the current environment?
Okay, so I'll talk about inflation first. We don't hold inflation risk on our projects, so the significant elements we acquire for our projects are bought in advance or committed in advance of a price being submitted, and we hold our price for only the limit of the time that we can get a supplier holding the price. So let's say steel, which is a commodity that we buy a lot of, and it moves in cost in significant ways. It's probably gone up 25% in the last 2 months. We would say get a price of a steel supplier, a hedge for 14 days, and our price to our client will include that price and hold the entire price on the project for 14 days. And most projects aren't able to be committed within a 14-day period. So what normally occurs is we would then either advance order the materials with the client's commitment, therefore an advance payment before we get the entire contract, or we will renegotiate the materials prices upon final negotiations of the contract. So we don't take on any material inflation cost risks, as, let's say, you've seen some of the major house builders who committed projects or construction some a year ago, and they're going to start building next year or this year. We don't do that. It's not never been part of our repertoire. We've never taken that position on projects, and it's just a method that has worked for us and will continue to work for us through this period. Labour shortages, we're not finding labour shortages at the moment. We're certainly not finding skill shortages. We're a premium company. We employ premium people. We've employed 20 people in Australia in Brockman in the last couple of weeks, maybe 6 or 8 weeks. And we are hiring in Asia. That is probably the one area that there has been some labour shortage, but it's now opening up because the border is opening up, because a lot of people work in Asia actually come from other countries such as Pakistan and Bangladesh, and the borders were closed, but now they're open. That is subsiding, but it is certainly a key focus of our management, key focus of myself. I think I held 4 interviews yesterday with potential future people. But when you've got a business that's growing like ours, got a good culture, got a good business, got good people in it, straight talkers, honest traders. It isn't hard to hire good people, and with you've got a growth story and you've got a sound business and an improving balance sheet, I think we've got an advantage over some of our other players in the market. And you're not having that issue, but we're certainly aware to it and waiting for the change, but it hasn't hit us just yet. We've got intention to hire between up to 20 more people in Australia and 30 to 40 more people in Asia over the next few months. I think we're about 320 this week. I think we were about 400 about 2 years ago, so we will need to get our staff numbers back to the 400 number over the course of 2022 and early 2023.
And then we've got some from the audience, but the first one is actually linked to the second question that was emailed in ahead of time. How should we think about margins and leverage to the rebound activity levels and the higher revenue that you're going to see from just kind of working through this backlog over the next 12 to 24 months?
Okay, so margins, well, we've got some safeguard in our margins. So the first tranche of projects, as we were coming out of the pandemic, we bid at commercial margins, and they were our normal margins that we'd always had set as rules in our business. The next tranche of projects that we won or winning around now, we bid at an inflated margin to take on account inflation we couldn't see, or things that labour shortages like that may well come down the track. And now you can see that the competitors, I think, from what I'm reading in the market, that the competitors are starting to understand that they need to also do that. So we're still competitive, even though we've inflated our prices. The current group of projects we're bidding, we've had to take a further price increase. So, inflation is alive and well because companies like ours and others are taking an advanced leading position, knowing that there may well be opportunity for additional margin, but there also may well be an opportunity for additional price risk of input price risk. So our commercial position is that our profits will grow and be much more substantial than had been in previous years, because you've got higher revenues. Your overheads don't grow at the same rate as the revenues, particularly when we'll have around a 50% increase in revenue, and your overheads don't grow nearly as significant as that. And in fact, we had hired some staff to try and take a lead position here, and that's probably why the FY22 second half result we've telegraphed to the market will be similar to the first half, because we've had to advance hire and mobilise the right people prior to the projects being fully secured or are getting underway. So we see our margins and our profits holding and growing as a result of our pricing policies and our ability to attract the right talent, but also we hired them in advance so they were embedded into their roles before these significant projects got underway.
Okay, great. And then final question, I'm just going to squeeze it in quickly. The return on equity is low, and obviously paying back the debt just on the pure mathematical calculation is going to lower it further. Just in terms of trying to improve that return on equity now that the debt has is going to be expired by the end of this calendar year.
Yeah, so well, that's when it comes down to the and net profit after tax, doesn't it, number, and that's where that's been challenged over the last few years as we go into the next period with much higher revenues and much better profit position, taking the risk out of the balance sheet, being comparable to our competitors now with no debt. Certainly, you can use debt for leverage, but in our industry where can be volatile periods, particularly pandemics and the like, it's a safer and better position, and our clients are much more endeared to our company when they see that we have low debt or no debt position. So we're actually in a better position to compete against the like companies in our group. So it's a balance sheet structure that we need to have to compete at the same level as our competitors, and our profits all growing will improve the ROI position.
Yeah. Scott, thank you very much. We're just up on time now. Thank you, as I said, for giving us an update on all things EVZ, and we'll keep an eye out on the ASX announcements platform for any updates on those contract wins that are currently out to tender.
Yep, thank you. Thank you all.
If you could please stop sharing your screen, because I know we have John waiting patiently in the wings here. Yeah, you're coming through now, John. Yeah, if you just want to, yeah, go. Yeah, I can see the cover slot. Wait now, just hold on. Just want to go back to PowerPoint there, John. Bring it back up, yeah, and yeah, I can see the cover slide of your presentation now, John. Although we haven't got you on audio.
There we go.
Okay.
Hopefully you can hear me now.
Got you on audio now, John. Yeah, and if we just go back.
Perfect.
Yeah, now I think we're 100%.
Great. Thanks very much, Mark. Appreciate it. Welcome, everyone. Thank you very much for the opportunity to present Knosys to you once again. First, I'd like to start off with, obviously, like most companies, our mission is a very simple and clear one. We deliver solutions that enable businesses to connect with their information and with their knowledge within their organization. And we do this through the delivery of 3 really fantastic SaaS-based solutions. In our portfolio, the top solution that we deliver is our knowledge management platform, Knowledge IQ. Now, this is a solution which is predominantly used in contact centers, support desks, organizations that have branch offices, etc., to help employees and customers find the information they need quickly and to really support that employee agent engagement with their end customers. So to make that very productive, a good outcome from both parties. The second solution that we deliver in the portfolio is our Green Orbit intranet. Primarily, this is an inward-focusing solution on a business's employees, and basically it's a platform to enable the employees to communicate, collaborate, share within the organization, and really build a really nice, very pleasant and productive employee experience. And the third solution in our portfolio is our library management solution, Libero. Primarily, this solution is designed to enable library staff, but more importantly, members, to be able to access resources and material and conduct the transactions necessary in that particular environment. So as you can see, 3 solutions, all addressing the management of information, and providing access to employees and to customers. Now, like everything, people ask me, well, what are the drivers for customers to acquire our solutions? The first one, obviously, is remote workers. Now, this trend started prior to COVID, obviously was heightened during COVID, but still exists today. And our view is it is going to continue. A lot of organizations are operating and will continue to operate in a hybrid model. The second driver for people buying our solutions is customer expectations of consistency. And what I mean by that is, in a lot of businesses these days, customers interact with that business via various channels. And it's taking into account the generational aspect of their end customers. Some of their customers still like to come to an office to speak with people. Some customers like to speak to people via a contact center, whilst another generation of customer is quite happy, quite content to interact with the business through their mobile phone. So coming through websites, chatbots, and things like that. It's important that a business delivers the information or manages that customer consistently across all those channels so that there's no disparity in that. The third element, which is a very strong driver for all of our solutions, is information governance and compliance. As you probably aware, a number of our customers operate in highly regulated industries. They need to be able to ensure that they have traceability, auditability on how information, how procedures, how processes, how they interact with customers, and be able to go back in time and validate what happened at that point. And then the final one is obviously content explosion. The amount of content that has been generated on a yearly basis has continued to increase. And what our solutions do is they really provide a magnifying glass so that the users of the solutions really get to just see the material, the information that they need to perform their duties, conduct their work. So there are four very strong underlying purchasing decision drivers, and that is pretty common amongst all the three solutions. If I go to the three solutions themselves, and it's a common question in terms of how do they relate to one another, there are four key themes, and these themes are at an operational level in terms of how people use the solutions, but they're also at a technology level in terms of our software development and our commonality in software development. The first is intelligent search. In all of those solutions, be it an employee, be it an agent, be it a customer, is going to look for information or look for something. Intelligent search means that if I'm looking for a particular thing, I phrase it one way. If you look for something, you may type in a different query. What we want is the platform to return the same response, the same material, irrespective of how you've structured that query as such. And that's the important thing from intelligent search within the platforms. The next one is personalization. And a lot of companies are calling it now the Netflix experience. Fundamentally, the solutions need to remember the users, or if it's customers, what they've used before, what they've looked for, and try and anticipate what they may be searching for or trying to engage with. So that Netflix experience of suggestions, just presenting relevant information, is a really important change to a lot of the solutions and an evolution of the solutions as we go forward. The next part is governance, and I mentioned previously. So one of our differentiators from a solutions point of view is our platforms have very high level of governance, auditing capability on the creation of material, how information gets in, how it's distributed, and more importantly, can we look at historically? So if a regulatory agency comes to them and says, 3 years ago, you were promoting this particular product, show us the material that supported that engagement. And that's what our solutions really focus on, these three areas. And as we go forward, a lot of these will become common components that will be shared across the three platforms. So if we look at Knosys from an operational and financial perspective, we are a SaaS company. Our major metrics is what's happening with our recurring revenue. So if you look at the bar graph on the right-hand side, this is a projection of our annual recurring revenue with the March 22 ARR, our projection of recurring revenue going out the next 12 months. As you can see, we have a history of growing our recurring revenue, and particularly in the last 12 months with the additional solutions to our portfolio, you can see that we've had a tremendous uplift, and we are currently have a run rate of about 9 million, and we expect to grow that by the end of June 30 as well. On the left-hand side is really a snapshot of some of our key metrics. At the moment, year to date, we've invoiced about 6.9 million in recurring revenue. As a SaaS company, gross margin is a really important metric for us. We're currently sitting at about 88%, and that's a pretty consistent percentage that we've had for many years. Our underlying EBITDA at the moment is a negative 400,000, and that is primarily due to increased investment in a number of areas, which I'll speak to shortly. But one of the significant aspects is in any technology company, investing in the product. R&D is very important to keep the product relevant, and we invest about 17% of our recurring revenue into our software development and our feature enhancements. And that's really important to keep those 350 customers happy. In terms of churn, we have less than 6% churn in the mid-market area, but we have been fortunate that we have had a number of increases in the annual price per user, and that's overcome any of the churn that we've seen over the last 9 months. Now, one of the key aspects for the board and the management of the company was to diversify our revenue, and we have achieved this through not only the multiple solutions, but also geography. Look on the left-hand series of pie graphs. In FY21, we were predominantly a knowledge management company. That represented 84% of our revenue at that time, and we had the beginning of the contribution from our intranet solution, which you see in green. Now, fast forward to where we are today. As you can see, we have a much better spread between our product portfolio. Knowledge management, still our largest at 39%, but Green Orbit, through its growth, is getting close to its contribution, and we're seeing the contribution from our library management solution starting to hit our books in this financial year. So that's a good distribution in terms of de-risking the business and giving us an opportunity to grow in various markets. Now, the revenue by geography, once again, if you look at FY21, we're predominantly an Australian, New Zealand-based business with some small contribution coming in from obviously the US and also from the rest of the world. When you look fast forward again to today, you can see that now Australia and New Zealand represents about 71%. The next largest market for us is the US, which is 17%, followed by the EU, UK, and rest of the world. So we've done a really good job over the last 12 months with the expansion of our solutions to get that diversification in those 2 key areas. Now, if we look at our underlying organic growth, here's a representation of the operating revenue split up into half years. As you can see, from FY20 to FY21, we had growth in our core business of knowledge management, and you can see the green extension to the second half FY21, which was the acquisition revenue contribution coming in to the business. As you can see in the first half FY22, we now have highlighted the acquisition revenue coming from Libero that has hit the books, and you can see where our base organic revenue is at that point. So we're steadily growing the business through a combination of organic and acquisition revenue, as you can see. So in terms of where we are as a business. Obviously, our aims are to continue being a business that operates globally. We operate in 10 plus countries as we sit here today, and we've got 5 offices throughout the world. And those 5 offices fundamentally support our 67 people, 20 of which are in R&D and software development, which you would expect of a technology SaaS company like ourselves. But all in all, that's supporting our customer base, which is a global one of over 350. And we have over 380,000 licensed users of our technology. In terms of our customer base, we have a really fantastic customer base. As you can see from the top graphic, we've got some really well-known brands that have selected Knosys to acquire one of the portfolio solutions. If we drop down the bottom, this is really to give you an indication of our spread across industries. At the moment, government is our largest contributor in terms of customer numbers, and that's because of Libero operates in a lot of councils, and we have a few other government organisations in the green orbit space, and more recent times, obviously, the knowledge management space. The next largest sector is industrial, driven predominantly through green orbit as such, and then financial services, which is a combination of green orbit and knowledge management. And the really growing sector for us seems to be health, and that seems to be expanding for us, not only in green orbit, but also potentially with the knowledge management. Now, this middle pie graph is just to give you an indication of the spread of customers. So 13% of our customer numbers are enterprise customers. These are customers that have over 1,000 users using one of our solutions. Mid-market, we classify as less than 1,000 licensed users. And as you can see, that makes up the bulk of the customer numbers. But in terms of financial contribution, enterprise contributes a lot from a value point of view versus mid-market, because those customers have a lower annual recurring revenue. Now, the total number of customers is currently sitting at 353. And so we have a really good spread and volume of customers in the business across the 3 portfolio solutions. In terms of our people, which are really important to us as an organisation, one of the things we wanted to really promote is, out of our 67 people, we're a big believer in women in technology and in the digital space. We have over 30% of our staff are women, and more importantly as well, over 30% of our executive and senior management are women. So, the company really values the contribution, and we try to support women in technology as best we can. If we look at the middle graph, this is to give you a view of our distribution of staff. Obviously, with 350 plus customers, our customer support team is the largest within the business, but this is closely followed by our technology, as you would expect. The people who develop the platforms, keep putting enhancements in. And the next largest grouping is our sales and marketing, which we have significantly enhanced over the last 6 months in order to deliver our strategic plan over the next couple of years. In terms of locations, most of the staff are Australian based, as you can see by the third pie chart. The next largest is our support team based in India, followed by US, and then the rest of the world. So very much an Australian company, but growing overseas in terms of personnel. In terms of financial highlights, obviously I'll let you read this at your leisure, but the key points I want to bring out are the increase in total revenue and recurring revenue when we're comparing first half years from FY21 and FY22. So both up from 88% and 156%. In terms of our operating cash flow, even with our increased investment for our strategic plan, we're still cash flow positive over the course of the first half, and we will expect to be cash flow positive over the year as well. And that's really important, particularly when you're investing in growth. The board and management want to make sure that we have the capacity to fund our growth plans, and we do that through being positive cash flow on a yearly basis, and also what our cash reserves are in order to support that. On the right-hand side are really just some highlights, and the biggest highlight is we've started a 3-year strategic growth plan that was kicked off in September last year, and we've really focused on increasing our sales and marketing spend, accelerating our product development, and expanding our operations overseas. And we expect this investment, the fruits of those investments, to starting to come through FY23 and also in FY24 as we go forward. We've already mentioned where our recurring revenue level is at, and that will continue to grow by the end of this financial year and into the new financial year. And obviously Q3 was a big cash receipts quarter for us, as will Q4 and particularly Q1 in FY21. So there'll be a lot of cash coming into the accounts with some big customers paying. We've also mentioned that and released to the market the Optus extension, and that's a big opportunity for us to continue that long-term relationship with them as we are doing with others. So solid cash position, positive cash flow, we are growing the upper line, and they're the areas that we like people to really focus upon when looking at the business. In terms of an update, in terms of where we are today, Knowledge IQ, we've had a really good quarter for our knowledge management solution. The pipeline had a number of RFTs in Q3, and we have visibility of more RFTs in Q4 that we anticipate participating in. In regards to our success rate of those RFTs in Q3, we were really successful and won 75% of those opportunities. And those are the opportunities we've announced to the market, such as Service TAS, Service SA, and a few days ago, Health Direct. And these are really good projects in government, and we certainly have visibility of more projects in the government space. So that's really set us up well from that aspect. We also completing negotiations for extending our major knowledge management customers, and people will see the announcements of those recontracting or extensions in the coming months as we go forward. So we've had a really good period for knowledge management. Green Orbit, its pipeline is particularly focused on transitioning customers from its legacy product, which was called ID, to Go, Green Orbit. We are now at a position where over 70% of their customer base has transitioned. When we acquired this business 12 months ago, only 30% were on the Green Orbit. So we've transitioned well over 40% during the past 12 months. The balance of this calendar year will be focusing on transitioning the remainder, and that the benefit of that for the organisation is the transition increases the annual revenue per user and provides professional services project work for the business. So that's been really good. We're very pleased with what we've achieved there. And now we're getting into that transition phase of really investing heavily in digital marketing, particularly for the first half of FY23, to really start generating new sales opportunities, having transitioned most of the customer base, so we can refocus, redirect our resources. With regards to Libero, we've been focusing on the transition of their customers once again from on-premise to cloud. Once again, we've been reasonably successful. We've had over 5 customer wins in Germany and Australia, particularly in academic and specialty libraries. We've participated in a number of tenders, which has really helped us refine the product roadmap for this solution, bearing in mind that we've only had it for less than approximately 6 months. So we've really had an accelerated learning opportunity, and that really is delivering on our roadmap over the next 12 months, where we'll invest in new features and products, and that will then trigger the next wave, next generation of Libero customers. So that's a bit of a snapshot of where the business is at the moment and what we're looking at. Just really wanted to finish off on our growth strategy. This is our strategic goal. I mentioned we commenced our strategic plan September last year, and it goes out 3 years. And towards the end of 2024, what we're hoping to have is towards 1,000 customers across our portfolio of solutions. We want to be recognised as a leading vendor of workplace solutions, and more importantly, we want the licensed users to go from its 380,000 to start heading towards the 1 million users. And that's our goal. That's what we're investing in as a business. And in order to achieve that, we've really got a 5-part strategy. The first part, which is really important when you've added portfolio solutions, is focus on the existing customers. And that's what we've been doing over the past 12 months. And more, not just from a retention point of view, but growing what revenue we derive from those customers. And we've been doing a good job at increasing the number of licensed users, sites, and upselling to those existing customers. And you can see that through, if you look at what's happening with our ARR. We're also looking for opportunities to cross-sell and also to upgrade customers, generating further revenue. So that's been our focus. We're now starting to transition more into number 2, which is the new customers. So to do that, we've invested increasing the size of our sales and marketing teams, our spend on digital marketing initiatives, all with a view of increasing new customer captures during the course of FY23. And also an element of that is around branding. So making sure that people recognise who we are and come to us if they're looking for one or more of our solutions. And growing brand awareness is really a key thing from our point of view, which is why we've separated it out. And it's important because it helps attract new customers because they are aware of us, and helps us retain our existing customers. The other is we want to be employer of choice. We want to attract the right people, the right talent to the business. Having a strong brand helps that. And also having a strong brand means that people are willing to pay a little bit more for what they consider to be a premium solution. And we want to position ourselves as a premium solution in our target markets. We're also investing in expanding the features and capabilities of our solutions. You have to, as a technology company, keep the product relevant, add new things that may differentiate you from your competitors. And so we have a large investment in our IP, and particularly our software development. And hence, if you go back to our staffing numbers, technology was the second largest, support large, and obviously sales and marketing. And they're the areas that we're really focused upon. However, we still, whilst we have a very organic growth focus over the next 1-2 years, we still are open to adding to the portfolio. If an opportunity comes up, we'll obviously assess it and see if it's right for us. And that's still an element of our plan. But the first 4 are all relative to growing what we've got from a business point of view. So just wrapping up from an investment point of view, highlights. We're very much a company focused on organic growth in Australia, US and the EU. We are a SaaS business, which means that our gross margin always remains high. And by having a corporate service approach, that is combined marketing, combined software development, and things of that nature, having that corporate service layer means that as our revenues grow, the profits will start dropping through to the bottom line. We are definitely a leading digital workplace solution provider in the SaaS place in our markets. People know us, people are aware of us, and that's been validated by the customers that you saw on our customer slide. We've got some great enterprise customers. We've got some fantastic large number of mid-market customers, and these are based globally. So we're not just locked into Australia at the moment. And more importantly, in the markets that we're operating within, put together, they represent over 25 billion. So we believe that there's opportunity for the company to grow. It's a matter of delivering on our plans and entering those markets. Just the final aspect is looking at our capital structure, and particularly the share register. I think it's important for investors to realise that the management directors have a reasonable stake in the business at 47%, at 4.7. Our founders represent about 6.8. We have a substantial shareholder that represents 19% of the business, and we've got institutional representation of approximately 3%, and the rest retail. So there's good alignment with the business between the directors, the executives, and some of the key investors, and we hope to continue that relationship as we go forward. And that's the end of the presentation, and more than happy to take questions.
Hi, John. We're slightly gone over time, but I'm going to ask forgiveness from our next presenter. I just want to squeeze one or two questions in because we've had a few come through there as you were talking. With the acquisitions of Green Orbit and Libero, will this dampen the historically pronounced seasonality in cash flow? Soft March quarters, strong September quarters, as they get more embedded over the next kind of 12, 24 months?
The answer to that is we expect it to soften the cash flow cycles. We still have a number of enterprise customers who pay in advance for 12 months. So you'll still see some spikes, but we expect the level of those spikes to be reduced over the next 24 months and have a more sort of consistent cash flow quarter to quarter.
And I'll squeeze one more in here. With the recent Health Direct contract, can you please quantify the annual recurring license component of this contract? The announcement noted the solution is expected to grow over time as services are broadened. Is it feasible that the contract value could double over time?
Look, the answer to that is on the announcement. So the recurring revenue is probably somewhere in the order of 120 to 130 per annum. In terms of expansion and broadening, yes, we're really excited to be involved, which is fundamentally the health department, both at a federal, particularly at a federal level, but also state level. One of our objectives was to acquire this opportunity because there is room for significant advancement in terms of licensed users over the next couple of years with it. So it was an important win for us against our competitors, and we hope that, and by what we're led to believe, that this could be a large opportunity for us and have a seasonal increase in its contribution.
Okay. I'm going to have to leave it there, John.
That's all right. Thank you very much.
Send those additional questions to Katie, or if anybody would like to reach out to Katie, her email address is on the screen here, or indeed to John directly. Apologies if we didn't get to your question, but I do want to try and keep to the time slots for each presenter as best we can. So John, thank you very much for coming back and giving us an update. If you could please stop sharing your screen, because I do know we have Ron Hodge, CEO of InvestSMART Group, waiting patiently there. And Ron, if you want to start sharing your screen, I'll let you know when I can see it coming through.
Okay, let me see how that works.
Your audio is sounding good, Ron. Yeah, it's coming through. Yeah, you can see me. Yeah, perfect. I can see the cover slide of the presentation now.
Hey, Mark, can you also see me when I switch to the website?
Yeah, just click out there. It should come up. Yeah, I can see the website now as well. Yeah.
Okay, cool.
Okay, yeah, we're back on the Prezzo now.
Yeah, cool. So am I starting?
Yeah, take it away.
Okay, thanks, Mark, and thanks everybody for joining us today. I don't know how many people know about InvestSMART, so I thought I would start with the basics. Our sort of mission statement is helping all Australians grow and protect their wealth. I think, that's an easy thing to say, but we are client first. Over the last 20 years, it's been a long time in the making. Our business, Paul Clitheroe is our chairman, Alan Kohler's also on our advisory board and runs our Eureka business, Effie Zahos. So we've attracted some really, really well-known personal finance type gurus in the industry. And I think we've attracted those people because we are that client first. We only deal directly with retail clients. So we don't generally, there's a lot of advisors on our database that use our, different services and subscriptions, but generally we are direct to market. So what, a lot of people in the industry talk about robo advice. We rather use, because there's no robots in our business, we rather talk about a digital platform, and that's what we've built over the last sort of 20 years. I think the easy way to show you what we've sort of built is if I just show you the website, and then I'll take you through this presentation that we put out. We put out an investor deck pretty much at the end of every quarter to help everybody sort of work out what we're doing and how we're doing it. But if I just go quickly to the website, what we think of robo advice, robo advice around the world, started with sort of like Betterment and Wealthfront in the US. You've got StockSpot and SixPark and a few others in Australia here. Most of those sorts of businesses are really only looking at sort of one-dimensional advice to clients, and that's predominantly you do a little fact find and then they give you a portfolio of ETFs that match that risk profile, generally being a conservative, balanced growth or high growth portfolio. We think digital wealth or digital platform or robo advice should be a lot more than that for our clients. And so how we look at it is, what can we do that a financial planner does in Australia to help clients invest? And as we know, the cost of personal specific financial advice or going to an advisor is really expensive. I think some new research came out and it talks about being about $3,500. Typically, our clients can't afford that, or their balances are too small, or they believe they can do it themselves and don't really need an advisor, or use an advisor like we use a doctor, and basically only when you sort of like need personal specific or very specific advice do you go to an advisor. We think we complement advisors. We talk to lots of our clients and say go to advisors if you need really personal specific advice like transition to retirement. But if it's general advice and investment advice, then we think we've pretty much got that covered. How we do it is over 3 different brands in our business, and we've brought these businesses into InvestSMART Group over the last 5 years. So InvestSMART is your traditional robo advice, as you would call it, which is really portfolios of ETFs. We then have Eureka Report that Alan Kohler started up and Alan Kohler still runs, which is a subscription-based business, and it's more macroeconomics. A lot of this stuff is about SMSFs and how running your own SMSFs. We do a lot of technology stuff. We do a lot of income stuff. And, that is a really important part of our business. And when I go through the presentation, I can show you, why that is so. Then we also have Intelligent Investor, which we bought in 2015. And most of these businesses all started sort of 20 years ago. We all sort of started up in the dot-com boom and survived. Intelligent Investor is purely specific ASX stock research, more so about running portfolios. And we have 3 portfolios we run, which is the Australian Equity Income, the Ethical Share, and the Australian Equity Growth. And most of our stuff is about how to build those portfolios. And so what we think is, from a retail point of view, we don't sort of like go, well, you all fit in the one box. We have clients that go across the whole 3 brands and buy products from each of them, or they might actually just decide to be with Intelligent Investor. They've got a broking account. They just need some research and some information about which stocks to buy and how to blend those together into a portfolio. And so, you know, people just use Intelligent Investor. These are 3 businesses to give you an idea of sort of what all of these businesses are now on the same technology stack. We have built all of this technology in-house. So even from behind the scenes, the contributors and the analysts and all that, they actually post all their own stuff up in AdminX once it's been through the editors and whatever else. It's pretty much all self-serve systems from both our staff into the actual website, and then also how our clients then consume that content or investment products. As I said, we pretty much all started about in, late 1990s. We have 726,000. This is actually live numbers. If you go to the website, it'll go up daily. We manage about, when I say manage, we track through our portfolio manager about $34.6 billion. That's over about 120,000 investors, clients. And the number of articles we write, and this is really important, and we'll get back to this, but we write about, we've written since the start about 123,000 long form sort of articles that you find on Intelligent Investing Eureka report, similar to SMH or the AFR. We have 400,000 visits pretty much a month, 20,000 a day. So that's unique visitors to the website, so to this group of websites. We have about 2,000 free accounts set up every month. So out of that, so we look at this as funnels. So you have 400,000 visitors coming a month, you have 20,000 a day, and out of those people, about 2,000 of those people set up a free account per month. The database, as I said, is about 726,000, and to date we have about 25,000 paying clients. I think that makes us probably one of the biggest digital platforms, definitely independent digital platforms in the country. And if you think about what we need to do as a business going forward, now that we've built all these systems, everything's on the same technology stack, we've got a great staff that's been with us for a long time. Really, if you've got 25,000 clients, paying clients, over 726,000 free members, that's about 3.5%. That's not bad. But for us, it's how do we get that from 3.5 to 4% or 5%? How do we convert those 2,000 new free accounts every month coming to our ecosystem? And how do we convert those guys into paying for a subscription, buying an investment product, or buying, one of our ETFs that we've listed on the stock exchange? So that's sort of a roundabout definition or explanation of what our actual business does. And so to go back to the presentation, hopefully this works. Mark, let me know if that didn't work, mate. What I wanted to do is go, firstly, before we go through all that stuff, this is probably sorry, mate.
You're back on the preso now. Yeah, all good.
Yeah, cool. Thanks very much. So what I've just explained there by showing you in real life what the websites and business looks like. This is how the business works together, and it's really important. So interesting enough, when we look at the P&L, you'll see that our business, when I first started InvestSMART in 1999, we were probably one of the first sort of digital platforms online, and we distributed everybody else's managed funds. And so then I sold that business to Fairfax in 2007, and that was when the Future of Financial Advice came in, and it grandfathered trailing commissions and meant you couldn't get trailing commissions off new financial product. So we were exceptionally good, and we think we still are very good at online distribution or direct distribution to clients, very good at building systems, very good at building websites, but all of that is all direct to mums and dad investors in Australia. And as you know, FOFA came in, it sort of stopped us in our tracks because we couldn't promote other people's financial products. So we set about creating our own suite of financial products or investment products. So the first part of our business, as I sort of alluded to before, is funds management. We have that InvestSMART side, which is your traditional robo-advice, which is those portfolios of ETFs that we blend together into a conservative balanced growth, high growth. We also do asset class specific funds, such as international equities, Australian equities, property infrastructure, and fixed interest. And that just allows our clients who are filling the gap. So they might be heavy, might be overexposed to Australian equities and cash, and they don't have international equities, and so they can just go buy a bit of that and they can get back into a more diversified portfolio. Then, as I said, we bought Intelligent Investor in 2015, and Intelligent Investor is purely about research and portfolio construction in those models that I explained before, which was the growth, the income, and the ethical. And a lot of our clients were saying, Ron, that's great, but I'd love to hit the big red button and just actually buy those rather than actually having to replicate your recommendations in my own broking account. And so we've launched over the last few years, we've launched 3 ETFs that mirror those model portfolios. So we've got an income ETF, which is INIF. We've got a growth ETF, which is IIGF, and we have an ethical ETF, which is INES. And that's sort of like the funds management area. As you'll see in this report, we've got about $500 million in funds under management. That grew by about 50% in the last half. So what is amazing about our business, or really, we're really proud of, is that we've sort of built all this stuff. No one really believed you could go direct to customers, and it's really starting to pay off now. We're, in the last quarter of last year, when the markets were, a little bit kinder to us, I think we put about nearly $100 million of funds under management in that one quarter. And I think once the markets get better, we'll get back to, doing 100, and then we'll go to, more than 100, and you'll get that geometric growth that we expect. The second part of our business is really important. This is the content publication. And a lot of people think that, why don't we sell these businesses off and just concentrate on the FUM? But as an ecosystem, and how you actually make direct to retail work in Australia without spending a fortune on marketing dollars, and everyone talks about cost per acquisition and cost per lead and whatever else. What we do is we create a lot of content. So as I showed you before, back on the Real website, I think we've done about 130,000 articles now over the last 20 years. We do about 1,500 or 2,000 articles a year currently. And that content, apart from we sell that content as subscriptions under Intelligent Investor or Eureka report, we also set that content free after about 6 months. And that then gets you a really long tail in SEO. So after this presentation, if you went to Google or Yahoo or whatever else, and you searched for pretty much any term in personal finance, whether it's BHP share price or whether it's something about an SMSF or whatever else, you will find one of our 3 brands in probably the top 4 search term, organic search results. And that's what gets us all of these clients, these 400,000 visits per month, 20,000 per day, and 2,000 new members per month. It's because of this content. Content is king for, we believe it's king for a retail business, online retail business like ourselves. Then we also have all these other tools to assist clients. We have the portfolio manager that I said that's a free portfolio manager, similar to sort of like a share site. That's a paid subscription service. Ours is free, and over about 120,000 clients in that. They manage or monitor about $36 billion worth of assets. We do our own automated statements of advice, like other robo-advisors, but a bit different. We look at asset allocation. So it's an asset allocation tool that allows people to see whether they're underweight or overweight specific asset classes, and how our products can help them get their portfolios more diversified and risk adjusted. We do boot camps. So we do a lot of things. So what I'm trying to explain to everybody is what we think as digital advice or robo advice is way more than just simply a statement of advice. Ask 5 questions. Yeah, you're a conservative type guy. Here's a conservative portfolio, and that's the end of it. We think digital advice in a digital platform, or if you're trying to replicate some parts of what a financial planner does, it's not only the investment advice, but it's also all the information and content that goes along to help those clients make decisions, make good decisions, and also help them monitor their investment portfolio. So I think I've explained enough about what InvestSMART is. Now I'll just go through the investor pack and what we've done. This was to December last year, so this is for the half 21. As I said, funds under management grew by 51% to 498 million. I think that's up to about 520 as of March. Professionally managed accounts. So that's what we call the InvestSMART robo advice. We call them professionally managed accounts. And that grew by 48%. Funds under management fees up by 116%. Cost-based subscription income is 9% higher. Just going to that content subscription, we always thought that that would be low single digits in growth. And we think that, I think the 9% was an anomaly. It was due to lockdowns. We saw, when I say we get 400,000 visits a month, that's general during lockdown, that went up to like 1 million. Our 2,000 members a month went up to 5,000 or 6,000. I mean, there was an influx of people during lockdown into financial services, and we attracted a lot of those members, which was great. But now it's going back to normal. Subscription business is a bit of a pain in the butt business. But as I said, we love it because of the content and that long SEO, search engine optimization, that brings us so many sort of free members and free eyeballs to our website. 3 core products we've explained: the InvestSMART, Intelligent Investor, and subscriptions. Again, that low cost of customer acquisition, because of this unique ecosystem, it's integral to our success. And well-recognised ambassadors, and I've explained that. Paul Clifford, our chairman. Effie Zahos used to be the editor of Money, is now on Today's Show all the time, works with CanStar. And Alan Kohler is our editor-in-chief. Fund under management, so we've explained this is just all the graphs. Interesting enough, they all go up. That's why you show these sorts of graphs. But, the business is growing, and it's growing really nicely, and it's growing quite rapidly. Up until recently with the market downturn. So just to give you, market downturn is, I know it's bad for everybody, but for a retail direct to customers, we haven't seen much outflows. So we're still net growing clients and funds under management. But what happens is, even though you tell your clients and you tell mums and dads that nearly the best time to buy is when the market's low, not when it's high, people, they basically don't, they put their head in their sand and they don't do much. And then once the market's sort of starting to go in the right direction for a period of time, then we see them all jump back in and we're off again. But it is the downside to a direct to retail business. But on the upside, retail money, as we all know, is very, very sticky. And so we don't see outflows, well, not very many or much. But during these periods of time, we also don't grow massively until the markets are sort of like stabilized and getting into better territory. So this is so you can start seeing this geometric growth that I was talking about before. It's really starting to take off. If you look at Betterment and Wealthfront over in the US, those 2 businesses started in 2008 on different sides of America. They have to, all funds management businesses have to file with SEC every month their FUM and their distribution, and whether it's wholesale advisor or retail. If you look at, you can track that over, you can just basically go and download all their filings each month. If you look at Betterment and Wealthfront, as I said, started in 2008. They took 6 years to get to $1 billion. We've taken 6 years to get to $500 million, obviously different size markets. Then Betterment and Wealthfront over the following 6 years nearly doubled their FUM, or close to doubled their FUM every year to 2021. and that puts them now at about $33 billion each. I'm not saying that's where we're going to get to, but I do believe that we can, you know, in a normal market, I think we can pretty much double our FUM every year, and that's our sort of like targets. Now, whether we do that is another thing, but I mean, if we take examples or parallels from what they've done in the US, I think it's definitely achievable in Australia as well. So we break down our FUM into two parts. One is the InvestSMART PMA accounts, and for that, and why that is an exceptional product, and we have just people falling over themselves getting into it, is because it is capped fees. So we cap our fees on our PMA accounts. So we charge $550 max per year. So that's $100,000. Our fees are 0.55%, capped at $550. Most of our clients are sort of like under or around that. And so it's a aspirational target, I guess, for our clients. But we do also have a lot of high balance clients that are leaving financial advisors. They think they can do the investment part themselves, especially using ETFs. And this is an easy way for them to do it. As I said before, we blend 6 to 8 of what we believe is the best ETFs in the country to get them a diversified portfolio matching their risk profile. We give them full tax reporting, full execution, and we cap those fees at $550. Obviously, those clients are paying the management fee with inside the ETF as well. But part of the choosing or picking, professionally picking those ETFs is we make sure those ETFs are broad-based index huggers that have very cheap MERs. On the Intelligent Investor side, so these are the 3 Intelligent Investor ETFs, and they're all growing nicely. So the active income is that INIF, INF, active growth is IGIF, IIGF, and active ethical, is INS. An interesting thing that we started doing a year ago is the secondary raises. And so everyone goes, why would anyone buy a secondary raise and get away from, you know, we say it's free brokerage, you don't have to pay the $20. We just issue new shares or new units in that fund. And the reason being is we have a lot of our clients who just love it, and they just go, I forgot to top up, I'll put another 20 grand in or 10 grand. In last year, we were putting on average about every time we did that, which is once a year, we do a secondary raise for each of these ETFs. We were putting in about $20 to $24 million into each of those each time. In the first quarter of this year, we did INS and did about 14 million in a not so great market. And we just did IGIF again in a month or so ago, and only put about $11 million into it. So again, you can see how the market really plays on us, but you know, we're still pretty happy with those results because we think in a bad market, we can still put another 1,000 clients in. What we see is we see the same sort of number of people investing. They just lower their balances, because one of the things we try to hone into all of our members is dollar cost averaging. You know, rather than doing nothing in a bad market, do something, invest a little bit, and then maybe next month invest a little bit more. And so we're really trying to educate our clients into doing that. And so what we're seeing is we see the same number of clients investing in these products. And so what I was saying before, even with InvestSMART and the PMA, we're seeing net new investors into these products. We're just seeing them with lower balances at the moment. So the P&L, you know, exciting stuff is the management fees, as you'd expect, going up, the subscription fees going up. This line here, this commission income, this was as a result of the Royal Bank Haynes Commission, Royal Commission, and they ended grandfather trails. Remember, I said before, we started our business as promoting everybody else's managed funds. We used to get $6 or $7 million a year in trailing commissions, which was grandfathered up until January 2021. And then after the Royal Commission, all the fund managers stopped actually paying us. And this was the last $594,000 or $600,000 we got at the end of 2021. And all of those commissions ended. We didn't get another dollar from the 1st of January 2021. And so you can see how this business has really reinvented itself. So we had to replace about $7 or $8 million of these grandfather trailing commissions into our own revenue from our own products. And I think we're very successful at doing it. And now from here, you can see the revenue growing. So for a few years there, you know, I think InvestSMART share price got down to like 5 cents, which I was buying furiously. And the reason being is everyone thought we were going to die a horrible death because we'd run out of money, and they didn't realize that the business we put in place was going to be so successful. Lots of operational leverage in this business. As I said, we've done pretty much all the dev development. The websites are the websites now. We've got a few more products coming out that I'll talk about in a little bit. But our cost base is pretty flat, apart from probably marketing dollars. We did, I think in March this year, in the last quarter, we became profitable, and you know, that'll just depend on, you know, I think we'll probably actually dial up the marketing expense in the next year. And so we'll probably dip around, bit below, bit above profitability, but we only spend money on marketing because we get so much traffic anyway to our websites through the articles and the search engine optimization. We only really spend marketing dollars if we know it's going to actually work within our funnels and our conversion rates. And so you'll see us dial it up a little bit sometimes. And if it works, we'll keep on going. If it doesn't work as well as we think, we'll sort of like taper it back again. We talked about that already. We've talked about this sort of like unique ecosystem with the brands and the content. We've talked about the funds management business, which is one side is the InvestSMART side, which is capped. On the ETF side, that's more traditional funds management. We charge 97 basis points or 0.97%. There's no cap on those ETFs. The only way you can have a cap on some of your products is if you have other products that you can sell these clients. So a big part of our business internally is how we cross promote. So we have a lot of clients who are, you know, they're doing core satellite. So they have an investment in the capped fee products. Might have a balanced portfolio in the PMA, and then they go and do a couple of the II ETFs to get a little bit more, you know, what we would call alpha, or they, you know, to spice up their portfolios a little bit and get some outperformance. And we also have clients who, in the subscription business, they actually subscribe to Intelligent Investor, but they also invest in the ETFs. And the reason being is the ETFs might have 20, 25 stocks in them, and rather than them actually replicating that within their own broking account, what they do is they buy the ETF, and then they might not like our weightings. They might like some of the stocks in that portfolio a lot more than what we have conservatively allocated to it. You know, we might allocate 4%, and then they go and buy a few more units or shares in those companies they like a lot in their own broking accounts. And so we have a lot of people who do both. And that's the secret sauce. I mean, you need people. If you've got some fees that are capped, you definitely need to make sure that those clients are also interested in other products. Low cost per acquisition, as I was saying before, you know, we have a very low cost per acquisition. That is the beauty of our business. And that's purely because of this unique ecosystem that I don't think anyone else really does as well as us in Australia. And I think that as we keep on growing unique eyeballs to our website, signing up free members and then converting those free members, as I said before, we're at sort of like 3.5% overall. You know, we want to get that up to 5%. And we think that is, I don't think we can get to probably double digits, but I definitely think we can get higher than 3.5%. And that's what pretty much we all work at today, is how do we improve the products and improve those conversion funnels. So, and then cross promotion between products as well. This is sort of like the other people we compare ourselves to. You know, you've got what used to be called Cashworks, Self-Wealth, Raise, Premium, Hub24, Net Wealth. We sort of like look at these guys and we look at, you know, our funds under management relative to our market cap, and then what other people's sort of funds under management is relative to their market cap. We still think, you know, our share price last year got up to about 54 cents. That probably got a little bit ahead of itself. It's back now to like 26.5. I think when this presentation came out, the share price was about 34 cents. I think that a lot of these stocks, you know, we've probably been brushed a little bit with tech stocks and the pullback in tech stocks globally. You know, we don't really concentrate too much on the share price, concentrate on growing fund, growing revenue and growing clients. I think we'll continue to do that. We haven't seen any of that go backwards yet, touch wood, depending on what the market does, obviously. But I think that over time, as we continue to grow revenue and we quarter on quarter, put out good reports, I think, you know, the share price will correct and the market will realize what we're doing and how we're doing it. So capital structure, as I said, you know, when we put this out, we were 36 cents, so it's 15 million market cap. Those net tangible assets there are 4.51. Interesting enough, before I took over this business in 2015, my predecessor was investing in a portfolio of sort of venture investments. And we always told the market when I came along that we would always look for liquidity events to sell down those businesses, because we'd rather invest that money in our own business rather than invest it into other people's business. We had two businesses left, which was Spriggy and Equitize. And our last ASX announcement, I think last week or the week before, was we just sold that company that held those two ventures, Spriggy and Equitize, for 3.2 million. And so now our cash is, you know, you can pretty much add cash at bank then 3.85, 3.2. So we're around about that 7 million mark now in cash. Substantial shareholders, Leyland Asset Management in Melbourne own about 18.94. This is back then in Feb. Perpetual Small Company Fund owns about 10.67. I own about 10%. Management owns probably another 20%. Management and staff, we have an ESOP program internally that we do a third for a year, a third for a year, and a third for the third year. And that works very well and is a great way to retain our awesome staff. So I think we talked a lot about funds under management, subscriptions, products and services. I know, Mark, we're going, the last one went over a little bit, so I'll keep it short so we can get into question time. I think the one thing that we are about to launch, and we did a test pilot on this end of last year, is Fund Later. And Fund Later is Australia, probably the world's first invest now, pay Fund Later product. The whole idea is the client puts in $4,000, we'll put in an additional $6,000, so you have a $10,000 portfolio. That money can only go into those diversified portfolios in the InvestSMART PMAs, and then they have this rapid payoff that gets them into this habit of saving $325 a month for 20 months. So $300 over 20 months is that $6,000 principal repayment, and the $25 for 20 months or $500 is the fee that we collect for that. We sent out one email when we came up with this idea. We came up with this idea last July. We launched it by September. We sent out one email. We had 400 applicants. 200 of those people actually funded and were off and running. We didn't call the other 200 people because we didn't have enough money. We were funding this off our own balance sheet. It was really a pilot. It went exceptionally well. All of the clients we've been talking to love it. We've been using insights from those clients, from those 200 clients, to now develop our own app that we're about to launch. Basically a unique and individual, you know, it's by itself, so it's just a Fund Later app, and that's really to start going up against the Razors and you know, Pocketbook for CBA, Stake, all these other guys that do, you know, these apps and get smaller balance clients. Our minimum for our PMA is $10,000. So we always found it hard to attract that younger audience. And we think Fund Later actually does that for us. How we're going to fund Later, because obviously we can't do it off our balance sheet forever. We're expecting thousands of clients into this product. We're launching also, well, we actually soft launched it last quarter, which is Alan Kohler's Eureka Asset-Backed Loan Fund. And so the thinking behind that is really like peer-to-peer lending. We've got a lot of high balance clients that have a allocation to cash. And so we think that the Eureka Asset-Backed Loan Fund will attract a lot of investors that are interested in basically funding Fund Later and getting a pretty high yield. We think the yield on that will be, you know, definitely 5% plus. In fact, how we've structured that product is if we don't get you 5% after fees, then we actually don't take a fee ourselves. We don't get paid. Alan really likes the product, and we're going to launch that probably in the next couple of weeks. And so you can sort of like imagine Fund Later as we get demand for Fund Later products. We've then got to walk up the Eureka Asset-Backed Loan Fund to actually get funds in there to fund the Fund Later. And we've got to walk those two up together. Now, I don't think it's been done before, and it's exciting, but I mean, the success, you know, in the next year, I guess we'll find out how successful we are at walking these two products up side by side, because they literally depend on each other. If we have too much money in the Eureka Asset-Backed Loan Fund, they can't actually fund Later clients because there's no demand that side. Then we'll obviously have a cash drag on the yield for Eureka Asset-Backed Loan Fund. And on the opposite side, if we get too much demand for Fund Later and we can't actually fund these accounts, then we're going to be upsetting those people. And, you know, and if we don't have enough money in the Eureka Asset-Backed Loan Fund. So it's going to be interesting. And, you know, we're all pretty excited about launching these two new products. That, I think, is pretty much the end.
Okay, thanks, Ron. We have gone a bit over time, but we've just been kind of running a little bit behind schedule all morning. But I just wanted to get 2 quick questions in, if we could. I mean, you mentioned the raise guys there and a whole swathe of other people doing various different things in the sector. Now with your ETFs, is there opportunities for, you know, those ETFs to get onto other platforms like Raise or, you know, some of the robo advice guys, so that, you know, they're kind of distributing your products, or at least they're on the approved product list for when they're pulling these portfolios together? Is that a possibility?
I would say no, to be honest. And the reason being is that robo-advisors typically use broad-based index-hugging ETFs that are, you know, an iShares or a BetaShares or a Vanguard, because the fees are like, you know, 6, 8, 10 bips. I mean, they are so cheap, and you're getting the whole market. You know, these are active ETFs. They're highly exposed because there's only 22 stocks in it. So it's you know, I wouldn't call them a high conviction fund. You know, you've still got a fairly big spread in there of stocks, but they're 97 basis points. You know, like that's an expensive ETF unless you're outperforming. And I haven't seen any robo advisor that you know, Raise would be using. Well, I know Raise uses broad-based indexes. I know, you know, pretty much all of them do. I think, you know, we have advisors that like these products, and advisors are putting money into these ETFs, but I wouldn't call it robo advice. We don't allow these ETFs into our PMAs, so we definitely don't. And the reason being is our algorithms for the selection of our ETFs look at 5 different things. One of those is fees, one's liquidity, bid offer spread, size of the fund, and then tracking to the benchmark. And so these 3 ETFs, actually, if you look at them, that ENS is pretty much the top performing ETF in ethical. I think the income one is pretty close to being top as well, but they're above the index. So you would fail that tracking measure, and you'd fail on our own algorithms. You would fail the tracking and you'd fail the fees. And so they would never, apart from the fact we'd never do it, but the fact is even our algorithms wouldn't actually allow those ETFs to be included in our own professionally managed account portfolios.
Okay, and I mean, we recently saw News Corp taking a stake in Stockhead. Is there another potential content vertical that, you know, might go in there alongside Eureka report, or, you know, that would give you access to, you know, a different slice of the market or a different demographic to the market? Or are you happy with, you know, where, you know, with all the kind of legacy businesses now sold off and the trailing commissions, and are you happy with, like, okay, what we've got now, we just need to kind of sell, as you say, you know, sell more and penetrate more into our existing base, get that 3.5% up to whatever it might be, 4 or 4.5?
Yeah, correct. I think, you know, we looked long and hard at, you know, we know all the subscription businesses that are available in Australia. Most of them do pretty much similar stuff to ourselves. So I don't think we need to do that. I think, as I said before, subscription businesses are a pretty tough business. You've got to, every year, you can imagine you're asking them to put their hand in their pocket and get their credit card out again to pay. It's not like a funds management business where those fees automatically get taken out of the fund. And then you have all these clients, Mark, that, you know, their credit cards expired or their credit card's been cancelled. And then, you know, even the automated, you know, it's a tough business. I think for us, you know, we love those businesses because our clients love them, and they've been around for a long time. But I think, you know, we really love them because it gives us, you know, content is king, and it gives us this long, what you call a long SEO tail of people searching terms and finding these old articles and then clicking through to read them and seeing what else we have on offer. You know, that's gold for us. You know, another subscription business isn't going to increase that SEO, if you know what I mean. I think what we're really looking at now is looking at a lot of the podcasters. You know, we do a lot of affiliations with podcasts. So Equity Mates, Rask, you know, there's heaps of them. We're doing a lot of stuff around affiliate partnerships. So we built a massive system where we can actually start paying affiliate partners. And so we've just done a deal with CanStar to start that off. And we'll look at other partners in that area. So, you know, partnering with News Corp or partnering with Fairfax or partnering with NRMA or partnering, you know, people that have large distribution eyeballs, you know, that is interesting for us. But actually, we don't think we need to acquire those businesses to be able to get access to their clients.
Okay. And you mentioned Betterment and Wealthfront. You know, are they kind of, in your opinion, the kind of best peers to look at or think about in terms of, you know, what the InvestSMART model and business can become on a go forward basis? Or is there, you know, another one maybe in the UK or Europe we should maybe think about looking at as well to try and see where they've come from to where they are now?
Yeah, so Betterment and Wealthfront are definitely on the investment advice side. So just InvestSMART's PMA. That's a very, you know, those guys are probably the best to you know, represent us, I guess. In the UK, you've got things like Hargreaves Lansdowne, which is probably more like us, which is probably more of a broader digital wealth platform. Hargreaves Lansdowne, though, basically invests in lots of other fund managers as well. So it's sort of like a fund of funds. So it's a little bit different to us, but, you know, Hargreaves Lansdowne, you've got Nutmeg in the UK as well. Then you've got, you know, numerous ones throughout Asia that have started up, like Stash in Singapore and whatever else. But most of the robo-advisors are really that one-dimensional, just the InvestSMART PMA side. I think that there's a lot more that robo-advisors or digital wealth platforms can do around the world in helping clients. And I think as as personal specific advice gets more and more expensive around the world, as more and more regulations. So the UK brought in RDR, I think it was, which was our equivalent to FOFA. A couple of years before we brought in FOFA, it basically sent 50% of the IFAs out of business over the following 6 months. That's why Australia actually grandfathered trailing commissions, because the UK didn't, and it put most of them out of business. And so Australia learned from that. But then the problem with Australia was, all the advisors didn't get off the drug. They loved the trailing commissions and just kept on taking them until the Royal Commission actually then said, actually, you know what? We got to stop this drug and basically repealed that grandfathered trails, and so there's no more trails left. So I think as personal civic advice gets more expensive, advisors and the amount of advisors in Australia now it's gone from 27,000 down to about 17,000 advisors now. And because a lot of the, as you probably know, Mark, a lot of them now, all the additional educational hurdles that advisors have to meet to be on the registry as an advisor, a lot of them are actually just hanging up their boots and saying, I'm too old for this and retiring. So I think advice is only going to get more expensive in Australia and probably in the rest of the world. And so I think that digital advice businesses like ours just have to step up and do a lot more stuff. What else can InvestSMART do? We don't do digital advice on life insurance. We don't do digital advice on transition to retirement. So there's a lot of things we don't do yet that you need a financial advisor for, but I don't see why in the future businesses like ours can't actually fill some of those gaps as well.
Okay. Ron, I think let's leave it there. We have gone a lot over time, but it was great to get the update, and thanks for coming back in and filling us in on where you're at and where you're going. It was great to hear the story again firsthand.
Thank you very much.
Thanks everyone, and have a good rest of your Thursday.